We think Renzi will fight extremely hard, one way or another, and by hook or by crook, to find a way to get state money in to rescue his banks.
So Brian, there is a renewed talk of a European banking sector crisis, and this has arose almost after the UK referendum. So what's the status of this crisis now, and what were the reasons for this?
Good afternoon. Well, the underlying crisis is really very little to do with Brexit and a lot to do with long-standing problems in the Italian and Portuguese banking markets. And of those, Italy is by far the larger and the most immediate. Italian banks have built up impairment levels which are now some 3 times the European average. And in total, the Italian banking system has bad debts of some euros 360 billion. That's a very sizable amount in the context of what they might need to recapitalize to build their capital ratios to an adequate level of strength. A particular concern is that Italy's third largest bank, Monte dei Paschi, currently suffers a loan impairment ratio reported by Reuters recently to be over 40%. That's an incredibly high level compared with the European average of just 5.7%. The temperature in this debate has been rising recently, and that's why the focus on this crisis is getting greater. And Matteo Renzi somewhat fueled the fires when last Thursday he claimed that Northern European bank derivative exposures, and there was a veiled, if somewhat unsubtle hint to Deutsche Bank there, were allegedly 100 times the problems those prevailing in Italy. We would argue that Renzi's numerical calculation is somewhat spurious. He was looking at the gross exposures of European banks in their derivative business, and in that context, Deutsche Bank has exposures, according to its 2015 report, of over 40 trillion euros. However, the actual net exposure, the real market risk that it's running, is a tiny, tiny fraction of that, barely 18 billion euros, billion rather than trillion. And therefore, the Renzi statement completely exaggerates the risks which European banks actually are running in their derivative pools. What it does highlight is that there is an increasing standoff politically between Southern European political forces, notably in Italy at the moment, and those in countries such as Germany, and also from the Eurogroup head, Jerome Dijsselbloem, yesterday, speaking also, suggesting that there is little that the European Commission and Eurogroup can do under current regulation to help Italy out of its current problems.
So Brian, you've mentioned the European Recovery and Resolution regime that was implemented by the European Commission in January of 2016. Has this changed the rules of the game, so to speak?
Well, it's certainly trying to. There's been a long-standing objective by policymakers in Europe to break the so-called doom loop by which financial sector problems are solved by local governments, the local state bailing out its banks in full, and in turn leading to government-level crisis. This we saw particularly in Ireland and to a lesser extent in Spain when that country took down part of its rescue package. But the European regime very much sets out a platform under which, where there are problems in the banking sector, they should be resolved in a particular orderly and disciplined fashion. So there may be rules in place, but actually applying them are very difficult indeed. And that is also the case if one were to extend bail-in to larger depositors. With clearly any large company, hearing that a few of their peers have lost money in one bank, would then be extremely guarded in having more than 100,000 euros in any organisation they deemed potentially to be troubled.
So you've mentioned some of the underlying problems that we're faced with Italian's economy, but it seems that the problems really have arisen following the UK referendum, and they've really been underlined and highlighted. So how do you see Italian banks going from here? What do you expect the next move to be, and who do you expect to give way first?
Well, the UK referendum perhaps introduced higher levels of uncertainty to the financial markets, but it certainly can't be deemed the cause of a long-standing and well-established problem within the Italian financial sector. Indeed, one really has to ask why it's taken Italy so long to undertake the necessary cleanup. Obviously, it has tried, and there have been capital raisings, but there hasn't been a fundamental effort to address this problem until really the current claims or efforts to get state rescue approval. Prior to the introduction of the ERD, it would have been considerably easier for such state rescue to have been contemplated without necessarily meeting such strident opposition. Although even then, state assistance would have needed EU approval. And we think that Renzi is going to come under enormous pressure, either to get a successful negotiation within the European Union, i.e. a political solution, and if he can't manage to find that, there is a strong temptation for him, potentially even to take a unilateral move and simply to make the state injection to some of the larger banks and then say this was an emergency move caused by post-Brexit volatility. One would be very cynical and question that argument, but it's a convenient excuse and perhaps a timely weapon for Renzi in his quest to find an appropriate solution to this very serious problem. Without that solution, Italy does run the risk that there will be a loss of confidence in its banking sector, that there will be at least a return to the economic recession from which the country with difficulty emerged only in 2015, and ultimately his own political future would very much be on the line. So we think Renzi will fight extremely hard, one way or another, and by hook or by crook, to find a way to get state money in to rescue his banks.
And all eyes are definitely going to be on this topic at the moment. So Brian, thank you so much for coming in today and sharing your insights.
Thank you.
That's all for myself and Brian, but if you did like this interview, do like and comment on dugoscopy.tv. Goodbye for now.